Today we're going to be talking about real estate depreciation. Hooray! And I appreciate that this can be a very boring topic, but don't worry, I'm going to edit out all of the boring rambling and all the unnecessary information post. But first up, you can't claim it for a house that you're living in, no matter what, and it can only be applied to investment houses. Real estate depreciation in Australia comes in two main categories. So the first is capital, and that can be claimed at 2.5% per year, and it can be claimed for every year that you're not living in the house. So you can move out and then move in and move out, and for every year that you're not living in it, you can continue to claim it. That is not really the depreciation that you need to worry about because it is small and it is pretty simple because you can only claim 2.5% per year. It is not game changing. The one that you really should be focusing on is plant and asset depreciation. So that is things that aren't structurally part of the house. So say hot water systems, carpets, and things that aren't designed to live for the entire lifespan of the house. And one of the benefits of this type of appreciation is that it can be claimed over a shorter time frame, some cases even as little as 5 years. And it is this type of depreciation that you can usually save thousands upon thousands of dollars on your tax bill every year. But there is a very big but. And that but is that you will not be able to claim this form of depreciation if you ever live in the house. All the items that you're claiming the depreciation on, they have to be brand new as of the time of the first tenant. And yes, there is the exception that if you buy the house and everything isn't brand new, if you're buying it from an owner-occupier, it counts from basically when the house was first brand new for you. If you do want to be able to claim a lot of depreciation, it is important that you never live in the house. And now that kind of raises the question, what about first home buyers who are going after the first home buyer's grant? Well, this is a very hard one because for the first home buyer's grant, you can only get it if you actually live in the house for 6 months. So this actually creates a bit of a predicament that do you get the $19,000 first homeowner's grant, but then lose my ability to be able to claim tax depreciation in future years. And unfortunately, I can't just give you a straight answer for which option is better because the amount of depreciation that you can claim changes for every individual house. But it would not be a freak absurdity if the lost amount that you could have depreciated would actually add up more within 5 years than what it would have been if you just got the first homeowner's grant. And so, unfortunately, there is no such thing as a free lunch. And again, I'll just reiterate, if you are just getting the first homeowner's grant and you are actually living in the house and you're not planning to make it an investment property, none of this will matter because you can't claim any of the depreciation anyway. But if you're planning to do that trick where you just did a sneaky move into the house for 6 months just so you can get that first homeowner's grant, just be mindful that you're probably costing yourself the equivalent amount of money and lost depreciation claims. And for this type of depreciation, how do you work out how much you can actually claim? Well, there's two main methods. So let's just say there's a $1,000 item that you want to claim over 5 years. There is the primary method, and with that method, you'll be able to claim $200 per year over the 5-year span. Or an alternative method is the diminishing returns method, where in the first year you can claim $400, the second year $300, third year $200, and so on and so forth until there's nothing left to claim depreciation on. This actually is a little bit useful to know, because say for example you've purchased a house and you do actually plan to move into it in say about 3 or 4 years, you're actually better off asking that the house be depreciated with a diminishing returns method rather than the primary method. And the last question that you probably have is, how do I actually work out what I can claim on depreciation? Well, unfortunately, it's not easy. You can't do it yourself, and your accountant can't even do it for you. You actually have to pay a quantity surveyor to do it for you. And unfortunately, this does cost a lot of money, but at least you can claim this expense on your tax as well. Congratulations, you made it to the end of the video without being too bored. Thanks for watching.